What if I told you that the greatest trader in history didn't become wealthy because he knew how to make money? He became wealthy because he knew how not to lose it. Jesse Livermore made and lost fortunes that would be worth billions today. He experienced incredible success, devastating failures, and remarkable comebacks. After decades in the markets, he discovered one principle that separated professionals from amateurs. Protect your downside before chasing your upside. Most people enter a trade asking, "How much can I make?" Livermore asked a different question: "How much can I lose if I'm wrong?" That single shift in thinking changed everything. Risk management isn't just a trading strategy. It's a philosophy that applies to investing, business, and life itself. Imagine standing at the edge of a cliff. Someone tells you there's a treasure waiting on the other side. Would you sprint toward it without checking if there's a bridge? Of course not. Yet that's exactly how many traders approach the market. They see profits. They imagine success. They dream about financial freedom. But they never stop to ask whether one wrong decision could wipe out everything they've worked for. Livermore understood something that most people overlook. The market doesn't reward optimism. It rewards preparation. You don't need to win every trade. You simply need to survive long enough to benefit when the right opportunities appear. That's why every decision begins with managing risk. Before Livermore entered a trade, he already knew exactly where he would admit he was wrong. He didn't wait until emotions took over. He didn't negotiate with the market. He made the decision before risking a single dollar. Most people do the opposite. They buy first and think later. A small loss becomes a bigger loss. The bigger loss turns into hope. Hope turns into denial, and denial eventually becomes disaster. Livermore believed that hope had no place in trading. The market doesn't care about your hopes. It only reflects reality. If the market proved him wrong, he accepted the loss immediately and moved on. Because money protected today creates opportunities tomorrow. One of the hardest lessons in investing is accepting small losses. Most beginners see every losing trade as a personal failure. Professionals don't. Livermore viewed small losses the same way a business owner views expenses. Every successful business pays rent, salaries, electricity bills, and operating costs. Those expenses don't mean the business is failing. They're simply part of staying in business. Trading works the same way. Small losses are the cost of participating. The real danger isn't losing a little. The real danger is refusing to accept a manageable loss until it becomes catastrophic. The difference between successful traders and unsuccessful ones often comes down to one simple habit. Professionals cut losses quickly. Amateurs let losses grow. Another principle Livermore never ignored was position sizing. He knew that even the best analysis could be wrong. No trader has perfect certainty. Imagine two investors making the exact same trade. One risks 2% of their account, the other risks half of everything they own. If the trade fails, one simply moves on. The other may spend years trying to recover. The quality of the idea was identical. The difference was risk management. Large positions create fear. Fear leads to emotional decisions. Smaller positions create flexibility. Flexibility allows clear thinking. Livermore understood that surviving was always more important than being right. One of the greatest mistakes investors make is becoming emotionally attached to their opinions. The market has no emotions. It doesn't know your entry price. It doesn't care how confident you are. It doesn't reward effort. It rewards accuracy. Livermore accepted this reality. When the market changed, he changed. He never argued with price. He followed the evidence. Because stubbornness is expensive. Adaptability is profitable. Patience was another form of risk management. Many people believe patience simply means holding investments for a long time. Livermore's version of patience was different. He waited for exceptional opportunities. He refused to trade simply because the market was open. He wasn't interested in constant action. He understood that unnecessary trades create unnecessary risk. Sometimes the most profitable decision is doing absolutely nothing. As Livermore famously observed, the real money is made by sitting patiently, waiting for the market to present the right opportunity. Perhaps the most overlooked aspect of risk management is protecting your own psychology. Large losses don't just damage your account, They damage your confidence. After a devastating loss, many traders try to win everything back immediately. They increase position sizes, they abandon discipline, they chase every opportunity. The result is usually even greater losses. Livermore understood that preserving capital also meant preserving emotional stability. Small losses are easier to recover from financially. They're also easier to recover from mentally. Clear thinking is impossible when fear controls every decision. These lessons extend far beyond financial markets. Every important decision in life carries risk. Starting a business, changing careers, buying a home, launching a new project. Successful people don't ignore risk. They prepare for it. Before taking action, they ask themselves one important question. What happens if this doesn't work? Having an answer to that question creates confidence, because confidence built on preparation is far stronger than confidence built on hope. Jesse Livermore's life was filled with extraordinary highs and painful lows. His story reminds us that success without risk management is temporary. One reckless decision can erase years of progress. But disciplined risk management gives you something incredibly valuable. Another chance. The opportunity to learn. The opportunity to improve. The opportunity to be there when the next great opportunity arrives. Wealth is rarely built by chasing every opportunity. It's built by protecting yourself long enough to benefit from the right opportunities. So the next time you're about to make an investment, start a business, or make an important life decision, resist the temptation to ask only one question. Don't ask, how much can I gain? Ask first, what happens if I'm wrong? That single question has protected more fortunes than any prediction ever made. Because in the end, the greatest investors understand one timeless truth. Reward is exciting, but survival comes first. And without survival, there can never be reward.